Barton, first your take on the quarter, particularly when it comes to costs, and give me your take as well on whether this company can get direct-to-consumer profitable in fiscal year 24, as it says it still will.
Yeah. Look, I think that the spending on direct-to-consumer, they had flagged it would ramp. They didn't tell us exactly how much. It came up a bit more than we were anticipating. There was a little bit of cost pressure, I think, in parks around the launch of their Disney Wish cruise ship. This is a company that doesn't guide very specifically to the next quarter, so it's very, common for there to be some meaningful divergences. I don't think that this really is a definitive statement about, changing anyone's view of the viability of the company. I think that the more important, question is what you asked is, what's the trajectory of DTC? How comfortable are we in the theme parks? How are they going to be able to manage linear? And our belief is that the theme park business is iconic. It's an asset that you want to own when you get an opportunity to buy it at a discount. And I think you're being presented with that here. And I think that the DTC ramp is something that's going to work. I think that they have the scale. I think that there's an obvious kind of corollary where, streamers can grow revenues, fix costs, show, dramatic recovery and kind of margin. And Disney's clearly flagged that it's going down that road. And I think they have the content prowess to get there.
Are you surprised at the miss, though, in particular because Bob Chapek, he's known as a good operator and as somebody who is particularly focused on costs. It does seem surprising to some, and I'm curious as to whether you number amongst them, that they missed by so much given it was on the cost side.
They missed street consensus. They didn't miss what they had guided to because they don't guide that specifically. Clearly, they were aware. I don't think they managed to where the consensus, comes out. So, I do think that Chapek does run a tight ship. I do think that they've decided to lean into DTC, and this was a big spend quarter to kind of start really ramping things up. From here, I think they're saying that they're at scale, and we're going to see that kind of flatline out while the revenues grow, which is kind of drop to the bottom line. So I think it's darkest before the dawn in DTC, and we're at that dark point right now.
Barton, I wonder, the ARPU miss on streaming, does that hold in it lessons for rival streamers, or does it alter anybody's strategic direction?
You focused on cost, but I do think that in the opening question, but I think the ARPU, to me, was the biggest surprise. The degree to which ARPU came down because people opted into the bundles, Hulu, Disney Plus. And I think that I would worry about that, actually, but for the fact that they're putting through this substantial price hike in the U.S. and they're ramping the ad tier in the next month. So I think what we're going to see is, again, the darkest before the dawn in DTC play out, in that we've got a substantial setup for really meaningful ARPU improvement in coming months, coming quarters. I think that in particular, their ad tier is going to be really, really well set up. Hulu gets $3 billion of advertising. Disney Plus has the opportunity to do something close to that in coming years, which I think would be transformational if they manage Disney Plus like they have Hulu, which I think they can do. So, I think you can look past that given this setup.